Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, how you doing today?
We're all doing great out here on the West Coast. And yourself?
Doing all right. It's been 2 weeks since we spoke, and usually we speak every 2 weeks. And boy, it seems like every time crazy things happen, it's almost like the whole world changes. But I'm doing fine where I live.
And where exactly is that, Mike?
I'm in the state of Virginia in the United States, and even though there's, you see these protests on TV, they're going on over the place, even the city I live in, but they've been very peaceful, throughout my area.
Mike, the stock markets are up again, and it looks like the NASDAQ could even hit a record high. What's the story behind that?
Well, I tell you, the market has gone up more than I thought it would this quickly from the March low. That's for sure. And the NASDAQ is acting as the leader in the market because there's about 4 or 5 stocks, the so-called FANG stocks, that are providing almost all the gains for the S&P 500 and therefore heavily weighting the NASDAQ and making it go up more than the Dow or the S&P or the Russell. I'm speaking of Facebook, Amazon, Google, Netflix, those stocks. They made new highs a couple weeks ago and, ahead of the averages doing it. They heavily weigh the averages. But I'm still very cautious overall on the market, because it's not good if there's only a few stocks that are driving most of the gains. That said, there's many stocks that do look like they could go up, for a few weeks. But I would be concerned if, say, by the end of June, the NASDAQ makes some sort of top, and then we're like, well, what's going to happen then? But back in March, towards the end of that month, when this rally began, I was thinking it would be a rally into the country opening back up, and then we would have to see after that, because traders like to buy the rumor and sell the news, so to speak. So that opening up is now happening, and we got to figure out what's the next news item that can provide people a reason to buy into from a bullish perspective. And it's not company earnings, because they're going to be a disaster, obviously, because of the contraction that's going on in the economy. So I think the next potential piece of good news, if we really look out, could perhaps be the Federal Reserve announcing by the end of the summer that it's going to do something called yield control. That would mean they're going to say, we're not going to allow long-term bond yields to go up. We've always, influenced the short term. Now we're going to do the long term and just buy bonds, no matter how many are necessary, to make that happen. And if that's something they're going to announce, they'll probably plan it out in August, because the Federal Reserve has an annual meeting in the Midwest where they speak together for a couple weeks, and then they would formally announce it in September. That doesn't mean I think the market's going to go up until then, but it could provide a bullish backdrop to keep it afloat. And then we'd have to see what happens in the fall. But in the end, the most likely scenario for the economy is some sort of double dip recession with this opening up marking an expansion off of the low, that will probably last into the fall, and then we would probably see the economy slow down its growth or even tip back down into the negative. It's double dip recessions are a classic thing. And the CBOE actually put out a projection earlier this month saying it would take 10 years for the U.S. economy to get back to where it was in February. So we're really in a very long-term economic situation here. A friend of mine in Greece kind of explained to me, when you see, because he's lived through, what happened there over the past 10 years, and he says, look for the economy to really contract, which it has, and then have a nice growth spurt off the low that will look good in numbers, will help the unemployment come back down because it's over 20%, but then look for unemployment to, be 12 to 13 to 14% for years, and economic growth to also be very slow. And that's in line with what the government's projecting too. So that's the future. Today though, everyone is focused on stock market moves, the Dow being up, the NASDAQ being up, and more traders that are entering the market for the first time have a very short-term orientation, because they're essentially, looking at apps that show them what happens that day and not thinking about the future very much at all. Just whatever is up the most, they tend to try to buy it. So there's a lot of them that have flooded the market on Robinhood, E-Trade, Ameritrade. Those brokers have said that they've seen a record number of small individual investors come into the market since March. And this is something they already had been doing starting around November because of the free trading commission. So we're in an interesting time where many people are getting in the market for the first time. That might be part of the reason we're seeing the movements like we are, but don't look for anything to go straight up. People are experiencing markets for the first time and thinking this is how they all are. It certainly is not.
Do you have any advice for those people apart from it doesn't always go up?
Well, I would stick with looking at charts that, I tend to look at annual charts with 12 months of data, and they need to do that, or a couple of years of information, and not just the daily quote. And then use stop loss orders to manage risk. And if the market or a stock they're in, or sector, ETF, whatever it is, makes lower highs, like say the NASDAQ was to peak at 9,800 and then go down to 9,000 and go up to 9,400 and then break 9,000, then you're going to start a downtrend. If you're making lower lows, if you see a low the market makes a low, bounces up and breaks it, then you're in a downtrend. And you have to adjust, accordingly. And that really goes, with all markets. I think of, for example, gold in 2011, 2012, and silver, they ran up tremendously and made a mega bull market top, but it was really only silver that went up a lot, and the mining stocks didn't participate hardly at all the last 3 months of that move. So when you see a lot of negative divergences in a market, that's something to really make you start to be very, very wary and careful. So these are things I think we all have to be on the lookout for as the next couple months unfold here. So it's an interesting time we're in, that's for sure.
We'll have more with Mike Swanson right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, are junior miners a good opportunity right now?
Well, I think from a risk-to-reward standpoint, they are the best opportunity. And I'm someone that owns big cap mining stocks and some of the metals ETFs as core positions in my account, and I'm very bullish on all that. But from trying to make to buy something and aim for a large percent gain, at this point, I don't think you can beat big, small cap mining stocks. I mean, over the years, we've seen all kinds of new products come into the stock market, such as the double and triple exchange traded funds, that have attracted people who want to get big returns fast. And what we saw in March was many of these funds simply malfunctioned. There is a 3 times gold stock ETF that collapsed when the market declined in March and blew up. We saw that happen in an oil ETF. And people were buying these things because, look, you get a 3 times move, it can be 15-20% in a day. But these ETFs, even when they used to act normal, would erode over time, just the way they're designed. And other people try to trade options, which all options expire at some point, and 90% of options lose money because you are fighting a time decay factor of price volatility that's stuck in there that most of the time people don't think about. So that's a tough game. You know, another way people try to leverage is these options. But with small caps, you have the ability to make those type of returns that people try to make in options or used to do in triple ETFs without those problems. You don't have a decay factor, or a time expiration factor. And you just buy it like any other stock because it is a stock, and you just see what happens. And at this point, we're still so early into the move in gold and silver that there's many small cap mining stocks extremely cheap. So in the last 2 cycles, most of them had market caps of $25 million. And now you can find many with market caps of $5 million. You know, so they're trading at huge discounts to what I think they'll eventually be. Those are the type of cheap valuations still out there in the junior mining space. And in the last 2 cycles, what we saw was gold go up first, then silver start to go up, and silver would lag gold at first, then, you know, at times, you know, outperform it, then lag it, outperform it. But gold really went up first. Again, that's what's happened now. And then the big cap mining stocks would do very well, but the juniors would get ignored in the early part of those previous 2 bull cycles for the metals. So, for example, in 2001 or 2000, gold made an important bottom, and the HUI gold stock index bottomed that year out of a bear market that lasted for several years. But it wasn't until 2002 that the junior mining, well, actually, to take that back, it was really 2003 that the junior mining stocks really started to do very well. So I think we're getting near the point where that's going to happen. Probably when gold gets above 1,800 or 1,900, that's when those stocks as a whole will really start to move. But right now, some of the best ones are moving. Where with these, you just put the money in, the small amount of money, and you don't expect every single one to do that, but you buy 10 and 4 or 5 do really well, it just really adds up. So to me, this is probably the best time to be buying these stocks when gold goes above, say, 1,800 and the juniors get really hot. It'll still be fun, but this is the time to really pick them out and get in early before other people do. To me, this is like marijuana stocks years ago before everyone got interested in them. There's still not very many people interested in gold or silver. I mentioned that Robinhood thing. They show you the list of the top 100 most popular stocks people own by the number of people that own them. And as of this weekend, there wasn't a single gold or silver stock on the list, not even an ETF. So the masses are completely asleep on this, which is what you want.
Yeah, as they say, when people start talking about it at a cocktail party as if such a thing can happen now, that's not the time to invest in it.
No, that's the time to start selling most of the time. Or usually when you start hearing that talk, you still got some more gains to come, but it's not time to jump in, that's for sure.
We'll have
more. You really
more.
know what you're doing.
Yeah. We'll have more with Mike Swanson right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, are there areas that you should be taking your losses and running away from right now?
Well, there's many sectors I believe are troubled, but at this point they're rallying with the stock market for now. So, for example, airline stocks, casinos, in some of the REITs, those are all things I think in the long run are still going to be troubled, but they're lagging the market badly, which is a sign of trouble. They've been doing that. And I think, the airline industry doesn't expect to recover for 2 to 3 years, if not longer than that, recover and get back to where it was a few months ago, at least. And the casinos are at minimal capacity right now. They're just starting to open up in Las Vegas, but they're only opening 3 of them. The MGM chain, and I think Caesars is opening 2, and they're only allowing a couple hundred guests to even go, especially invited people, because of the coronavirus situation. And this is, what's going on with the leisure hospitality sector all over the country, all over the world, hurting airlines, hurting casinos and hotels and these things. And I don't believe we're going to end that situation probably till next year. So these are areas you think are things to stay away from. And they're going to impact REITs in those cities. So, for example, in Las Vegas, there's REIT companies that operate shopping malls and rent apartments and so forth. And Las Vegas is probably going to be the worst off economic area in the whole country now for years. This is according to the Brookings Institution. They put out a report of what are going to be the worst places affected by the economy. Las Vegas is the worst, and then parts of Texas due to what's happened in the energy market there. And Myrtle Beach is on the list, South Carolina, because it's a place of a lot of tourist activity. Ocean City, Maryland, which is another beach. So we have two things happening to all these areas. The virus is still going to keep people away, make people not want to fly. After 9/11, it took 2 years for the airline industry to get back to where it was before the terrorist attack happened. That's how scared that had made people, which I didn't know that till recently reading about it. So this is much a more real danger to people than that was, and will take longer for people to shake it off. But also the economic damage that's happening is very real, and you just don't snap your fingers and go back to the way things were at all. So in Las Vegas, after 2008, they did not lose foot traffic. They still had the same number of people going to the casinos and booking rooms as they had before 2008. The recession did not affect that. However, it caused the visitors to Las Vegas to spend half the money they were. They didn't stop their vacations. They just spent half the money. And we still got 20% unemployment. If we can get back down, hopefully by the end of the year to, 12 or 11 or something, then that's good, but it's still a lot of people unemployed. And the savings rate in the United States right now is skyrocketing because people also are saving what money they can save just in case there's another shutdown or something like that were to happen again to them. That's a lesson I guess a lot of people have learned from this, is you need some savings.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.